Which Canadian ETF is dominating the S&P 500? Is it the monthly income machine, the leveraged powerhouse, or maybe that sneaky one that never pays a dividend? The answer, well, it might just surprise you and maybe even change the way you invest. Hold on to your seatbelts, folks. This is going to be a good one. The US stock market is the largest and most influential in the world, and for investors, it's simply too big to ignore. And its big exchange, the S&P 500, well, that tracks the 500 largest publicly traded US companies by market cap. And it alone represents an incredible 40 to 44% of total global stock market capitalization. Holy banana bread, that's a lot. But here's the thing, if you're a Canadian investor, you've got more than one way to gain exposure. Whether you're focused on growth, income, or tax efficiency, there's now a growing list of Canadian listed ETFs that give you exposure to the S&P 500, each with its own unique strategy. So in today's video, we're putting 5 of the most popular options head to head, from classic index trackers to covered call income plays to leverage. We're breaking down what sets them apart and which one might deserve a spot in your portfolio. For this showdown, I've picked 4 very different styles of Canadian ETFs that all give you exposure to the S&P 500, and I've also brought in a wild card. It doesn't technically belong in this group, but it gets compared to the S&P 500 so often that it deserves a shot to either live up to the hype or take a walk of shame. A sub to the channel is the best way to hype future content. I can't wait to dive into these ETFs. But before we start pitting them against each other, we need to set the bar. And that means looking at the overall performance of the S&P 500 itself. After all, and if we're trying to find a beater, we need to know what it has to beat. Since one of these ETFs is still relatively new, we'll be using 1-year performance as our main benchmark for this comparison. So let's set that mark from August 2024 to August 2025. The S&P 500 has delivered a price return of 14.80%. Add in the dividends and the total return, well, that climbs to 15.77%. So that, folks, that's the number to beat. Now that we have our benchmark, I guess there's only one thing left to do. So without any further ado, let's do this. We're going to start with our plain Jane S&P 500 ETF. And for that one, I chose Vanguard S&P 500 Index ETF. It has a ticker of VFV. VFV is most investors' go-to when it comes to the S&P 500. It's a straightforward total return index ETF with a solid and reliable track record. No covered calls, no leverage. It's about as boring as an ETF can get. And sometimes that's exactly what investors want. At the time of recording, VFV was coming in with a price of $158.75. Their NAV sitting at $158.81. Those assets under management, a very nice looking $24.41 billion. And when it comes to a management expense ratio, that is coming in at 0.09%. That is pretty small, and it is exactly what you expect when you're looking at a passive index ETF for sure. Looking at their dividend, they do have a yield of 0.98%. It's a quarterly dividend of 36.9 cents per share. All right, getting to the returns. Even though we're judging on the 1 year, we're going to give you everything we got. We got a 3-year return on investment of 72.78%. Factor in the dividends, total return 77.45%. Looking at that 1 year, we have a return on investment of 18.41%. Adding in the dividends, total return 19.55%. VFE has beaten the benchmark S&P 500 by, well, a pretty impressive 3.78%. That's not too shabby at all. So yes, boring can be very profitable for sure. All right, let's move to a different style of ETF. This one uses swapping. So we've got the Global X S&P 500 Corporate Class ETF. So it has a ticker of HXS. HXS is a little bit of a different duck for sure. So instead of holding the actual stocks in the S&P 500, they use a swap agreement. Basically, that means they make a deal with a counterparty to deliver the same return as the index without actually owning the companies inside of it. So why exactly would they do this? Well, since they don't receive dividends directly, there are no distributions. That means no US withholding tax, and that will potentially lower taxes for Canadian investors. Instead of those dividends, all the growth is reflected in the ETF's price, making it a favorite for tax efficient investing inside non registered accounts. Inside of your TFSA, you don't got to worry about it, but this one is definitely ideal for outside of your TFSA for sure. At the time of recording, the price was coming in at $92.09, and the NAV exact same $92.09. Looking at their assets under management, that's coming in at 4.76 billion, and they have a management expense ratio of 0.11%. There's also a 0.5% swap fee in there as well. So just keep that in mind. Obviously, no yield, as we mentioned, because they don't have any dividends. So looking at their 3-year return on investment, that's coming in at 78.61%. 1-year return on investment, 19.33%. This more unusual swap ETF does demonstrate that it works. In fact, they did beat VFB on the 3-year. And even just falling short on the 1-year, they still beat the benchmark by 3.56%. All right, those were for our dividend growth investors. Let's move into the more income focused territory. We're going to look at a covered call ETF. So for this one, we will look at the Global X S&P 500 covered call ETF, ticker of USCC. USCC, well, they do bring the income, that's for sure. This ETF holds the S&P 500, but overlays a covered call strategy, meaning, of course, it sells options to generate extra cash. The result, monthly payouts that are higher than you'd get from just the dividends alone. Of course, the trade-off is that your upside is capped when the market rallies. At the time of recording, their price was coming in at $19.52, and their NAV, once again, the same, $19.52. Those assets under management, 400.68 million. Looking at the fees, their management expense ratio coming in at 0.49%. They also have a trading expense ratio of 0.03%. When it comes to dividends, now this is where the yields get a little higher. We're looking at 10.22%. It's a monthly dividend of 12 cents per share. All right, let's take a look at those returns. On the 3-year, that return on investment, 14.42%. Factor in the dividends, total return, 46.06%. On their 1-year, that return on investment, 5.17%. Adding in the dividends, total return, 14.86%. Oh boy, you can see how this ETF has lost some of their upside when you compare their performance to the benchmark. As well, they have fallen short of the S&P 500 by 0.91%. Of course, this is an ETF that, well, you're not really holding it for the growth anyway. You are holding it for the income. Also, just want to add in, if you did reinvest those dividends, you would have definitely hit that benchmark, no doubt about it. Okay, so we're going to take that same ETF and we're going to turn on the leverage. So that's going to give us our Global X Enhanced S&P Covered Call ETF USCL. So this one, well, it's taking the USCC strategy and cranking it up a notch by, of course, adding leverage. It's still a covered call ETF on the same S&P 500, but with about 125% exposure. That means potentially higher income and greater returns, but also at the same time, a little bit of more volatility. At the time of recording, their price was coming in at $22.85. Their NAV, $22.82. Those assets under management, 278.10 million. That management expense ratio, much higher, 2.18%, because obviously that's also going to incorporate in the cost of interest on that loan, because they got to borrow money to give you the 125%. They also have a trading expense ratio of 0.04%. Switching to their yield, that's coming in at 12.89%, monthly dividend 24.5 cents per share. Now, this one has not been around for 3 years, so it has a 2-year return on investment. That's coming in at 18.64%. Total return on that, 49.62%. Looking at their 1-year, and this is the one that counts for today's benchmark. Their return on investment, 5.06%. Factor in those dividends, total return, 18.41%. The leveraged version absolutely comes through and puts us well above the benchmark by 2.64%. I like that. But you will notice that they have not beat VFB, who still sits at the top in terms of total return. However, once again, if income is more important, that may not be a huge concern. Okay, we do have one more, and this is our wildcard ETF. I hear people saying that this income-focused ETF is beating the S&P 500 big time. Well, let's put it to the test. So for our wildcard, we're gonna, you know what it is. It's the Hamilton Enhanced U.S. Covered Call ETF, ticker HYLD. It's not a pure S&P 500 ETF, but it certainly does get compared to them all the time. Why? Because it's built to deliver high monthly income using US equity ETFs, many of which track the S&P 500 or similar indexes. And in a covered call overlay with a dash of leverage, and you've got one of the most talked about income ETFs in Canada for sure. At the time of recording, their price is coming in at $13.99, and they have an NAV of $13.80. Those assets under management, 937.90 million, and their management expense ratio, that's coming in at 2.37%. Looking at their dividend, they have a yield of 12.90%. It's a monthly dividend of 14.7 cents per share. Okay, let's look at that 3-year return on investment. That's coming in at 14.77%. Factor in the dividends, total return 54.81%. On the 1 year, this one is a bit more interesting. We have a 1-year return on investment of 12.82%. But, oh boy, add in those dividends, we get a total return of 26.77%. It looks like the hype may be real as they crushed the benchmark by 11%. Holy banana bread, it wasn't even close. They also beat our top S&P ETF BFB by 7.22%. Now, they do lose on the 3-year, but this is a big but. They have changed this ETF significantly in the last year, and as such, you really need to take the 3-year with a grain of salt. It is a different ETF. The makeup is completely different of the ETFs they're holding. They now hold all Hamilton, where they used to actually hold a lot of US ETFs. So it has absolutely impacted their performance in a very positive way. Okay, looking at the big picture, HYLD definitely came out on top in today's comparison. But here's the thing, each of these ETFs serves a different purpose. Depending on your goals, risk tolerance, and income needs, the best choice for your portfolio might be a very different one. If you are interested in any of the ETFs we looked at today, don't forget to put in a whole heaping helping of due diligence before you place any of your hard-earned money on the table. Let's continue that learning journey. Check out this video on HEQL. Thank you for watching, and I will see you in the next video.